I am Keith Harwood. Today we're going to be talking about trend following signals and using options with those kind of trading setups. So we've got a lot to cover. We kind of used an interesting, I guess, little subtitle of use this option strategy to multiply stock gains by 4 or 5x. When we start going through the examples, I think you're going to be surprised to see that actually it's a little bit better than that even. So I think this is something that you're going to really enjoy. But first, let's go through the disclosures since the lawyers wrote them. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please feel free to read through the rest of this. I'll give you guys a few moments to do so. And that way we can get into the real content here shortly. All right, hopefully that gave you guys all enough time to skim through and read through and understand what we're talking about here. So let's start with me. Before we get into the content itself, I think it's good to understand where I'm coming from so you understand why this topic is of particular interest to me. So I started as a volatility trader, an options market maker down on the SIBO floor. I started my career back in 2005. Traded through the subprime crisis and all of the craziness that happened along with that. It was a lot of volatility, a lot of great trading opportunities for the market makers. But as we came out of that scenario and everything moved to a more electronic market with really tight markets, and you guys have probably seen this in the options where everything is very, very narrow spreads, became clear that I needed to have more of an edge than the edge that a market maker gets. So I needed to have more of an understanding of how to really, really leverage the nuance of options. And also I wanted to get a little bit of a better perspective on how to predict price movement. So I moved away from the market making side after trading fixed income options and gold options during quantitative easing, got my MBA from the University of Chicago, focusing on analytic finance and econometrics and statistics and entrepreneurship and all this other stuff, and went over to a CTA, which is a commodity-based hedge fund. So the benefit of a CTA, and one of the, I think, important elements of a CTA is that they're often associated with technical trading and trend following trading. So this particular CTA that I worked with had a very fundamental background, and then their secondary edge they felt was the technical. So they could know that they believe oil should rally, and then they'd wait for the technicals to line up to jump on that trade. And then I came in and helped them with how to leverage that trade with the options when we felt that oil was both fundamentally bullish and technically bullish, and the options market was giving us leverage. So we combine all of that stuff and we start to find that there's really, really nice tools available in the marketplace to get leverage when you've got something right. And I, for one, frankly believe that the technicals drive the market more than the fundamentals these days, because these fundamental inputs come in less frequently and the technicals occur on a daily basis. So if I can find a stock that is trending higher, leverage that view with options, I can generate a much better income and a much better R&R from a trade than if I'm simply following a technical trading plan or a volatility trading plan. So that's why I started Trade Academy. That's why I started working with Option Hotline, so I can bring this kind of knowledge and this kind of information to you guys so that we can, work on building these better portfolios than simply just trading stocks for swings and for trends. And so this week, we're going to talk about that trend trading and why these trends matter. I'll get into systematic trading because that's incredibly important when we're talking about trend following systems. And then we'll talk about what these trend following signals are that a lot of computers and traders and everybody else uses. Introduce the concept of the stop loss and the trailing stop and why those are particularly important in a trend following system. And then I'm going to talk a bit about the options landscape, why I use them for the system, and how I can actually make the trade that much better by using options via building my cash position without actually giving up my leverage. And we just stay to the very end so you can get that special offer. It'll come after the examples. We'll talk a bit through everything today, and I think it's going to be a really exciting thing. One note before we get into the content. If you have any questions, just feel free to throw those into the Q&A or the chat. I will see them. If it is important for me to jump on that question immediately, I will. Otherwise, I'll save it to the end and we can address it at that point. But if you have any questions that come to mind, simply just type them in there and I'll address them as I see fit. We'll try to make sure to get everybody's questions answered relatively quickly. All right. So why trends matter? You guys, I'm sure a lot of you have heard the phrase, the trend is your friend, or the phrase, don't catch a falling knife. These are things that people talk about a lot when they're talking about trend trading. So the stock market wants to follow the path of least resistance. It's the easiest way for it to go. If a stock is already going up and it's just drifting higher, well, it's a heck of a lot easier for it to continue to drift higher than for it to start pressing lower. Why? Because the guy that's making money is the guy that's long. And the guy that's losing money is the guy that's short. So when you got a stock drifting higher like that, the guy that's long doesn't feel any pain. He's not really particularly worried. He may not even be looking at his account. The guy that's short is looking at it every day, trying to figure out where his out is going to be and why the stock is going against him. You can see extreme examples of that in these whippy stocks like Tilray today, where the short is just getting squeezed like crazy. But that's not what I'm looking for today. Today, I'm looking for stocks that are just going higher on a daily basis. Tilray is just all over the place right now. So we're looking for those names that are just going to go up a little bit every day, follow the money flow. Okay. One of the other things that I think we have to always keep in mind when we're dealing with trend trading is the natural money flow. So the natural money flow of the marketplace is in. Your 401k, your investment accounts, as people make money, what do they do with it? They invest it into the stock market. As their 401k balance builds every month, there's a natural buyer of the market, which means that there's a natural buyer of each of these individual stocks. It doesn't mean all of them are going to go up, but when I buy an ETF, I'm buying a little bit of every company. Now, there are other companies out there, and the hedge funds, the Warren Buffetts of the world, the Bill Ackmans, they come out and they find the specific names that they like and they start building positions. And those positions don't happen as quickly as I can buy stock. If I want to buy stock in Apple, I'm not going to move the needle. But if Warren Buffett wants to put millions, if not more, into Apple stock, hundreds of millions of dollars into Apple stock, he's going to move the price. So that's the kind of situation you find when you get a trending stock. It may take days or weeks or months for these guys to build positions, and they're naturally buying more and more and more of it, generating a trend that we can trade. We're just sitting back, enjoying this giant boat going through the ocean, and we're sitting in the wake where it's nice and calm, following along. So that's what I'm looking for when I'm looking for a trend. I want to sit there in the wake of a giant boat, not in the chop of the ocean outside of it. When I'm in the chop, I can get capsized. If I'm in the wake, I feel safe. That's part of the reason that we don't try to catch a falling knife when we are trend trading. Who is buying when the stock is dropping? Well, there's really two people buying. The guy that's short that just wants to cover his position, and the guy that thinks based upon value or something else that this stock is going to turn around. Well, if I have a value for this stock based upon a fundamental analysis, that doesn't necessarily mean that somebody else agrees with me and is going to help bring this stock back until another fundamental input comes around. That may be in the next earnings. It may be further down the line. It may be really when somebody starts buying. So when somebody starts buying, that's the time I want to buy, not when everybody is selling. It's a heck of a lot more painful to sit there and watch your account bleed while everybody is selling to you and selling below your price than it is to just jump in when everybody else is starting to buy. So it's a more comfortable position to be in. It's a lot easier. These long-lasting trends can lead to long-lasting profits. So when you see a stock like AMD, Amazon, Apple, I'm just doing the A's right now that have been pretty good over the last few months, they tend to feel pretty good. You know, I saw actually an interview today with Jeff Bezos, and he was talking about how when his stock was $100, you know, this is almost 20 years ago, and dropped to $6, the fundamentals were actually improving while the stock was dropping from 100 to 6. That doesn't mean that the people that paid 100 were still in when it got to 6. They may have stopped out of the position and never got to reap the benefits, reap the reward, caught that falling knife. But when people started to turn the stock around, those guys that jumped in then, they got to sit back, relax, and enjoy that long-lasting trend. And that's what I'm looking to do now. And for much more stock. You know, $1,000 worth at $100 a share, it's a heck of a lot fewer shares than $1,000 worth at $6 a share. That is now over 2,000. Actually, a little under 2,000 now. All right. So, you know, we've kind of introduced this concept of trend trading. What I really want to focus on now is how these trend trading systems are generally built. So a lot of trend trading systems, and in fact, most of them, I believe, are systematic. And what I mean by systematic is that they are fully rules-based. A discretionary trader has discretion to alter the system as they wish, both on the entry and the exit, or just on one of those two. A purely systematic trade is one that has a rules-based entry and a rules-based exit, and there's no deviation. So systematic trades are often applied to these trend trades because the trends are based upon a signal, a numerical signal that comes from the marketplace. If that signal does not come through, I do not go long. And when that signal is either voided or my exit signal comes, I get out. Now, if I'm doing something discretionary, I say, okay, well, here's an entry signal, and I take a little bit of time and say, you know, I'm going to wait on my entry because of this, that, or the other reason. That's now more of a discretionary trade, not a systematic trade. The reason I like to focus on a systematic trade for trend following is that a lot of these trend following programs are computer-based, which means that they don't have that discretion. They don't put emotion into it. They don't say, well, gosh, this stock, whatever name it is, Tilray, is worth nothing, so I'm not going to get in. No, it says this rule has come through. I need to get in because that's how I'm going to make my money. So it eliminates emotion. It eliminates those other thoughts in your brain about what stock's good and what stock's not. It just makes sure that the system is followed. And again, the key here is that in order to be systematic, we need a defined rule for the entry and we need a defined rule for the exit. If you don't have a defined rule for both, then this is more discretion. Once we have those, we can actually back test the trade and even automate it. And that's what all these computers are doing. They are back testing trades, then they automate them. And then the guy that sits there and watches that trade is just making sure that his system doesn't break, that he doesn't have a problem where the system accidentally doesn't exit position. He's just basically monitoring it almost from the tech side and saying, okay, everything is working as it should. And those are the systems that I want to try to mimic, find out what they're using as their signal, and then copy them because they're all bigger. These guys are, you know, the big systematic trades, the big trend trading systems, they have millions, if not billions of dollars going into the market. So my move isn't going to impact the market price, but they can. And so again, I just want to be in their wake, following along with what they're doing. Now I want to keep in mind one thing here. You know, this whole idea is really built on that big league stock idea that we have at Option Hotline. But once I incorporate options, there's discretion because I use my discretion and my background to try to improve my returns a little bit by using the nuance of options to slightly modify which trade I put on. That's where my discretion kicks in. So I use the systematic element to define my entries and exits, but I use my discretion to actually do the execution. Makes it a little bit harder to manage as many positions, but given the amount of money that, you know, an individual investor has relative to these giant hedge funds, we can handle that. It makes it a little bit more difficult if you're managing something in, you know, on the range of $500 million or $1 billion to add that extra discretionary element, of course. So now that we've talked about a lot of this stuff, let me just get straight into some of the signals that trend following systems use. Now, this is not all of them. There's a whole universe of other things that can be used, but these are some of the most popular, okay? So if you don't know much about trend following systems, you're going to start to get a little bit of a crash course on some of the most basic and some of the important ones here, and you can start to see how they interact with a chart and how the signals work. So I'm going to talk a little bit about simple moving averages, moving average crossovers, the MACD, it's a moving average convergence divergence, and RSI, it's a relative strength index. There's a lot more than that. The easiest way for me to show you guys this is just to simply show you on a chart what they look like. So that's what we're going to do right here. This is the S&P 500. And we're looking at this on August 31st, so the end of last month. And what we're looking at here is all of the candlesticks. White are days that the market went up. Red are days that the market went down, basically. And it shows you how the market has moved over the last year. So last year at this time, the S&P was trading 247. The end of August, it was trading about 290. So there was a good return in the market, obviously. We had about a 20% return over that 1 year period. Now, the elements that I want you to look at here are first going to be the simple moving averages, and they're color coordinated here. So the light blue on top here, that's the 10-day moving average. Below that is the 20-day moving average. The red line is the 50-day moving average. The green line there, the darker green, is the 100-day moving average. And then this guy down here that's sort of a purplish color is the 200-day moving average. So what is the moving average? It is the average closing price over that period. So a 10-day moving average is the average closing price over the last 10 days. A 20-day moving average is the average closing price over the last 20 days. 50-day moving average, average closing price over the last 50 days. All right, so you guys all have a good sense of what those things are. What do they mean? Well, let's think about this in the shorter terms here. A 10-day moving average. If the stock price is above the 10-day moving average, it means that the average buyer over the last 10 days is making money. So if somebody is using a time-based horizon to buy more stock, he's making money over the last 10 days. He's averaging in. If you're averaging into a short, you're losing money over this 10-day period. You're in pain. If somebody's building a position, the price is going to be above the 10-day moving average, and the 10-day moving average will be sloping upward. So you can see that at the end of 2017, we had an upward sloping 10-day moving average, but it was a little bit slow. And then in January, when money flow came to the market, it really ramped up the 10-day moving average along with the market. The long was in control. So a 10-day moving average, upward sloping with prices above, tells us that the long is in control. And vice versa on a downward sloping 10-day moving average with prices below. All right, so that's pretty simple. If the long is in control, it means that the short-term trend is up. If we do a medium term, like the 50-day moving average, as long as it's upward sloping and the prices are above it, means that the medium-term trend is higher. Longer term, like the 200-day, you see down here, tells us that over long periods of time, 200-day moving average is close to a year of trading, the trend is higher. And you'll see here why these matter for people looking for entry and exit signals. If you're looking for short-term trading, even though January, the market was going crazy to the upside, if you waited just for the index to close one time below the 10-day moving average, you would have captured the entire move, except for the last couple dollars. Now, you would have gotten chopped up afterwards, but you can see how that can help you get in and then back out. It's that lack of momentum afterwards. Now, if you're a long-term trader, just an investor, there was only one day where the market closed below the 200-day moving average, and that was there in the end of March. Even in February, we touched it and went back off. So people wouldn't have necessarily been out of the market if you're a long-term investor. But if you're a trader, you're going to look at some short-term moving averages and some long-term moving averages. What else do people use with those moving averages is when they cross. When they cross, it starts to show you that short-term momentum and long-term or medium-term momentum no longer align. So I said that if we're above the 10-day moving average, it means the short-term momentum is higher. If we're above the 50-day moving average, medium-term momentum is higher. What happens when the 10-day moving average goes below the 50-day moving average, or the 50-day moving average goes below the 100-day moving average, or one of these moving averages crosses below the 200-day moving average? It tells you that all of the different time frames do not have the same momentum and don't have the same trend. It's really nice when they all have the same momentum and the same trend. Because when they all have the same momentum and the same trend, then every period of buyer is buying and they're all happy. But when we get crosses, it can start to give you mixed signals. We had a lot of mixed signals basically from February until July. Then finally, in the beginning of July, the market got back above all these moving averages and they all started being upward sloping again. So we had about 5 months of just unclear direction in the market. That's that moving average crossover. When you see these crossovers happen, it tells you that the water is murky and it's not so clear what's happening right now. And the short-term moving averages cross quickly. The long-term moving averages take longer to do so. Because short-term moving averages have fewer trading days, so they react to short-term price movements faster. Let's talk about another signal that can tell you the end of momentum, and that's the MACD. So that's a moving average convergence divergence. This differs from the simple moving average in that it uses an exponential moving average. So what's an exponential moving average? It takes the time period and weights it more heavily on shorter terms. So the MACD takes 2 periods for a comparison point. It takes the 26-day exponential moving average, weighting the recent term trade more heavily than the stuff about a month ago, and compares that to the 12-day exponential moving average. And then it compares that to the 9-day exponential moving average. So you've got the red line is the MACD, the comparison between the 26 and the 12, and then the green line there is the 9. What does all of this do? It basically is trying to show us momentum falling. So the market had heavy momentum up in January, and then you can see that momentum flip when the MACD crossed. So you're just looking for points where the red line crosses the green line as signals of momentum slowing. This isn't necessarily built, in this case, to signal a short, but more so to signal the end of that momentum to the upside. There's other signals that can be derived from the MACD, but just basically the point here is that this is a lot of stuff with momentum and telling us how the direction of the market and how the money flow is shifting. It's another visual representation similar to that cross of a moving average or moving averages crossing one another, because this is all about moving averages crossing one another, but in an exponential fashion. And it takes a bunch of random numbers. Why do these work? By the way, why do these numbers work? Why do these moving averages work as signals? Frankly, in part, it's because they are a visual representation of what we're all trying to figure out is what's the direction of the market, but also people use them. So if I fill a room with 100 people and tell them all that they can only buy stocks that are above the 10-day moving average and only sell stocks that are below, well, guess what? Everybody's gonna be looking for the same stocks to buy and everybody's gonna be looking for the same stocks to sell. That's part of why these work, is because everybody uses similar parts of these signals. They're just piecing together different ones. So to generate a real system, it's not just the moving average, it's combining the ones that are most relevant. Excuse me. So to create one of these systems, we look for multiple signals. We combine them. We find the ones that are most powerful. And then we use them to generate our entry and our exit signals. Excuse me. The final one that I mentioned was RSI. That is a relative strength index. What it does is it compares the magnitude of moves on up days to the magnitude of moves on down days. And you can see that high numbers above 70, some people use above 80, are a signal that we're overbought, that basically people are getting a little too over exuberant buying. Numbers below 30, others use 20, tell us that people are getting a little bit too over exuberant on the sell side or a little bit overly aggressive getting rid of their positions. Sorry about that. So all of these things combine to give us a system. So what? Do the systems really work? I mean, yeah. I'll give you a good example. So our big league stock signal, it's pretty simple. And it's important that they stay pretty simple. But if you look at the results through August 31st, they work. They work better than the market systems. You basically are trying to keep yourself out of trouble. There is a question here about whether we're working off a daily chart and daily chart signals. Absolutely. When I'm looking for a trend, I want to look for longer time horizons. Now, a lot of these same principles can be applied to shorter time horizons. You can use a 5-minute chart, a 15-minute chart, an hourly chart, any of those sort of things, but those are going to have quicker turnaround times. For a true trend following signal that I'm looking to stay in the trade for months, I want to go off of a daily or even a weekly signal. But generally speaking, when I'm going for trend following, I'm working off of daily. When I swing trade, I can go shorter term, right? Because swing trades, for those of you that weren't on from last week when I talked swing trading, I look for trades for like 2 or 3 weeks. So I have shorter entry signals, shorter time frames on a lot of that stuff. This stuff is all based upon dailies because we're looking for longer holding periods and just to sit in that trend and enjoy kind of relaxing. All right. Let's get back into this a little bit more. So, there's an element to trend following systems that I think is important. And that is that simple is often great, but the key is to find the signal that not only gives you comfort, but also makes you money. Okay. So there are like multiple steps here when you're trying to build your own system. Number one, you want to keep it something that you understand. Number two, you want to be comfortable with it so that you know what your risk is. And number three, it has to make money. If it doesn't make money, it doesn't matter how comfortable you are. If you have too many elements to your system, you're probably overfitting the data. So just be aware of that as you start to go through a system. If you start building it up and you use every single technical signal as some weighting towards your signals, you're probably overfitting the data. If you have 1, 2, 3 elements, such, you're using a moving average along with the MACD, maybe an RSI in there as well, that's going to help you keep it simpler and help keep you from overfitting your data to optimize, quote unquote, your returns. And then you're just, you're fitting what could have possibly mattered to the market. There was a famous analysis somebody did a number of years ago saying, I believe it was butter prices in India were the best predictor of stock price returns or something weird like that. And, one of those sort of things where you're just overfitting data to just see what makes sense. And overfitting it isn't what makes sense. It's understanding the concept and then putting that into play once you're comfortable with it and making sure that it actually is a predictor of stock movement. Because if it's not a predictor of stock movement, it's not valuable to you. And also, when you're building one of these systems, do not forget that we need an exit signal. So let's talk about that exit signal right now. There's 2 ways you can do it. Number one, you've got that momentum flipping that gets you out. So it's not going to be at the high. Momentum doesn't change when the stock makes a new all-time high. It changes as it starts to come back down. So either you're flipping because of momentum or flipping because of your signal no longer being relevant. So if my signal was that I had to be above the 10-day moving average, my stop loss is when we get below it. Or if I have another signal input, such as a moving average crossover or a MACD that triggers a little earlier, that just gets me out a little faster. But the stop loss is the element that's crucial here, because without a stop loss, I'll never get out. Because I don't profit take on a trend. The trend is my friend. I want to sit with it as long as it's good. But when I start to see that boat turn, I got to look for another boat to sit in the wake on. So I got to get away from that one and find somebody else to follow along with. The stop losses for a trend following system are often a trailing stop. And the reason that we use a trailing stop is because trailing stops raise their price as the stock goes higher. If I just stuck with my original stop, I would have more risk as my trade is working for me, which makes me want to get out that much more. So let's take that SPY as an example. If when it was $250 at the beginning or at the in like August of last year, I got in and said that my stop was at 240. Well, that's great. As SPY continues to rally, I would never have gotten out because we never got back to 240. But if I had used a system that got me out when the 10-day moving average got crossed, I might have been out a couple of times on the way to the highs of January, but I would have been out in January or the beginning of February. My risk would have been dropping as we rose. So setting that trailing stop is a nuanced game. You can either set it up as a drawdown from current levels. You can set it up as a cross of a moving average, so just negating your moving average signal. You can set it up as a momentum swing like MACD or RSI. It all depends upon the system. But the one thing I will tell you, one of the simplest systems that I've seen is simply saying above a moving average, I'm long. Well, then that moving average is my trailing stop. So if I'm looking at SPY as it rallies, let's go back to that chart for a second. If I use the 10-day moving average, or let's use the 50-day moving average as my trailing stop. So I would in at 247. As we rally, I'm not getting out until that day in February. So yes, I would have been out at around 275, which is a big drawdown from 290. But I never would have chopped myself up along the way on the upside. So I would have continued to have about half of the gains, because from 250 to 290, I give up about $15 to $20 of the total upside by waiting until the 50-day moving average. If I want to be more aggressive, I use a nearer term moving average, but you can see that there are times where I get chopped up if I use a nearer term moving average, such as the 20-day moving average or the 10-day moving average. So that aggressiveness is driven by which signal I want to use as my stop, but my entry is also driven by that aggressiveness. The whole thing with this is that if I don't use a trailing stop, then my risk increases every time the stock goes up. Because if I'm stagnant with a level as my exit, and it's a fixed price, when the stock goes higher, I have further to fall. It makes it less attractive the better it becomes. I want the stock to look more attractive to me the better it goes. So the higher it goes, I want to be more excited about being in it and less concerned about the risk. That's why we use a trailing stop. One way to help myself to find that risk and add even more leverage is to use options. So I'm just going to give you a simple example. SPY, the S&P 500 ETF, had a really good year in 2017. One of the simplest things I could have done is just bought these relatively far in the money calls, the 150s, and held them for a year. In doing so, I nearly tripled my return by adding leverage to my trade. I buy in for $74, hold them for a year, and sell for $117.75. I make just under 60% versus a little over 20% on the stock market. So on a really good year in the stock market, I can triple my money, relatively speaking. I can do 3 times better. Now that was just simply put off of not necessarily the most efficient use of options and not necessarily the most leveraged trending element. This was the whole ETF. This is the whole market. So if I can now apply similar parameters to my trending stocks that I'm hoping and expecting and have seen in the past will outperform the market, then I should do even better than 3 times the S&P, and ideally better than 3 times the individual names I'm buying. This is just simple. This is not optimized. When I use an option, it's to get leverage and defined risk. So if I don't use options, we have an example, let's say a $100 stock. My stop loss is at $90. I can buy 100 shares and have the following risk profile. Risking $1,000. If the stock continues to trend higher, I can make a couple $1,000s if it gets to $120. That's a great little trade potential. It's very linear. It's very simple. It's easy to understand. I know my entry. I know my exit on the downside. And then this is just to give me a picture of the upside if it keeps going. Now, on the other side, let's say there's these calls that expire in a month. At the money, they cost $5. I'm still willing to risk $1,000 so I can buy 2 of these, and I'm not exiting until expiration. Well, then my risk profile looks like this. If we're $100 or lower, I'm going to lose $1,000. But if we trend higher and say get all the way up to that 120 price point, my profit's $3,000 instead of $2,000. So here's the comparison. 2 at-the-money calls or stock. At some point, stock is better. If this stock has no trend and it's just chopping around somewhere between 90 and 110, it's better. If this stock is trending for the month and continues higher and higher and higher, the calls are better. So what I'm looking for is these stocks that are trending so that I'm more likely to land somewhere up here than somewhere down here. We're not going to stay where we're at. That's the argument, and we're probably going to go higher, and I can get leverage out of this. Plus, if I buy 2 call options for $1,000 instead of 100 shares for $10,000, I have an extra $9,000 in cash. That's important. When I'm using trending trades, I know I'm going to get out of this option position usually before it hits 0. The goal is not to let these at the money or in the money options get to 0 if I'm wrong. The goal is never to let an option position go to 0 if I'm wrong, but I know that if I'm doing a swing trade, like I talked last week, that there's a really decent chance that they go to 0 if I'm wrong. If I'm wrong in this, I'm probably getting out well before expiration and well before I lose this much money. But in that same process, I've got all this extra cash that I can either deploy to another idea or have in my pocket in case the market has an absolutely catastrophic day. Both of these things are attractive to me. I can either add more leverage, or B, have more ammo in case of a problem, or C, combine those two things, defined risk and leverage and more. That's the benefit of options with these trend trading programs. A lot of times the leverage is where it really kicks in because we know that there's a greater likelihood that these stocks will continue higher. Now, I don't use at-the-money options for this, and I don't use 1 month to expiration because those don't fit the trade parameters. This was supposed to be just for a simple example. What we do use is a little bit more of a different approach. We use in-the-money options when we look at these, and then that generates this extra leverage. And this is the leverage that we're talking about. So if you want to look at this for where the leverage comes from, I talked about the proprietary signal for big league stocks that I can't really get too much into the details, but I can tell you we use a lot of the stuff I've talked about today and apply a little bit of options knowledge to those trades and apply some leverage. You can see the massive magnitude of leverage that we can get out of options. So rather than getting a 14% return from May 1st through August 31st, we were looking at an 85% return over 4 months. Just let that sink in for a second. 85% in 4 months. This is the kind of system that I want to use when I'm finding good trends. Because when stocks trend higher, I get paid in much bigger magnitude by using the options. Because I can afford to put more money into the market and put on more positions and then just have to manage my risk a lot more carefully. So that's what I do all the time is look at these positions and make sure I'm managing my risk, because there are times where we need to hedge this risk because we have more risk in terms of delta risk, in terms of net exposure than the stock position. But we also have cash on the sidelines so that we can always keep building up our positions. So by using options, I can actually build cash as these positions work. How do I do that? Well, let's say instead of buying those Jan 150 calls that were a year away in SPY, I bought the June 150 calls. They're far in the money. And then as the market rallies, and as those get a little closer to expiration, I roll from the June 150s to the January 190s. Well, those are $40 farther, $40 higher. I'm going to collect cash to make that roll happen because the market's well above both of these. So that trade, selling the June 150s and buying the January 190s, is going to collect cash. What does that do? That keeps me fully exposed to the market rally, but I also put cash in my pocket. And because I'm still applying my trailing stop, all I've really done is allowed myself more leverage now to go look for a new trade. It's a little bit complex to understand, so I'm going to get straight into an example here and show you guys what I'm talking about when I'm talking about rolling these positions and getting that cash out. So the first one I want to talk about from our big league options portfolio is here called Netflix. You may have heard of it. They do DVDs by mail. No, they also do them online apparently now. Although I will say I am probably one of the few people that still gets my DVDs in the mail from Netflix. So I guess old habits die hard. They're still making some money off of that though, off of me. So our big league options platform has a long signal on Netflix on May 1st, 2018, when it's trading $313. All right, so we got a stock that's trading $300. 100 shares costs $31,300. Or one July $270 call costs $5,300 because remember you get the 100 multiplier. That represents effectively 100 shares of stock instead of buying 100 shares of stock. So instead of spending instead of spending $31,000 to be long this stock, I'm spending $5,300 to be long this stock. So I'm getting 6-to-1 leverage. That's how we multiply our returns by 4, 5, or 6x. And yes, options have risk. Options have extra premium. So I'm spending a little bit more in premium. My break even is a move to 323, but I'm effectively just long the stock for a cheaper amount of money. Now, over the course of the next month and a half, our long signal still applied. So it's June 14th and we're up to 392. So the stock has rallied from May 1st at 313 to June 14th at 392, between 20 and 30%. And in that time period, the calls went from 53 to 123. So around 150%. But because our long signal still applies, we don't exit. We roll to a $340 call, $70 further up. So instead of the 270s, we're now in the 340s. 2 months later, now September. And that roll collects $57. So initially I spent 53. Now I collect 57. So net, I've collected money and I still have my long position in Netflix. Now, the trailing stop applies. So we see that that would have been a great time actually to exit, but our trailing stop from our system didn't really kick in until 340. This is the problem sometimes with those slower kickouts. Still good though, because we did that roll and because we took cash in, still made over 37% on the trade. That's a good system for me to make that 37%. I'm pretty happy with that. I wish I'd made a little bit more, but I honor my system and it allows me to stay in during this rally. And then when I get kicked out, I'm kicked out and I move to the next trade. Making money is the key here for me. And then I can take that money and I can put it into ADSK on May 11th. It says, hey, it's time to get in. So we look at ADSK on May 11th and say, okay, it's $136. And I get into the 115 calls for $26.40. So once again, I can either buy 100 shares for $13,000 or have a position representing 100 shares for $2,640. It's about 6 to 1. Then what happens? Well, in this case, the stock chopped, never really got anything going for it, and we got our exit signal. So what happens when we get our exit signal? We take off the trade. We lose 37%. So it's a little worse than a stock position that would have been down from 136 to 128. So call that 6%. Instead, we lose 37%. But the key with these options is that I know my max risk and I can move on to the next trade and have that potential for that big leveraged payout. Because in options, we can never lose more than 100%. But can certainly make more than 100%. Illumina Incorporated on May 1st gave us a long signal. September 24th, 210 calls were $41. So a little less than 6 to 1 in this case. But the signal says long, so we go long. Instead of spending $24,000 for stock, we spent $4,000 for this position. Still in play on July 12th, when the stock has rallied from 240 to 304. So the stock is up 25%. The calls are up over 100%. And we look at the roll. The September 21st 210 calls were $86. The December 21st 250 calls were $56. So again, I'm adding 3 months to my trade. I'm moving my strike up by $40, collecting enough cash here to almost pay for the trade. Originally, I put in about $4,000. Here, I'd be collecting $3,000. And so now, for a total cash outlay of $1,000, I have a position that represents 100 shares down at 250. That's pretty good. And then what happens? Well, as of August 31st, market's not telling us to get out. These 250 calls are up to $108.50. The total profit from initial entry, from that initial $4,000 entry, is over 200%. It's 237%. That's that mega magnitude payout that we can get by having the options and then rolling the options. I can tell you that our system has since rolled this position because these calls are getting pretty juicy. They're very far in the money. But as of August 31st, we were getting the signal that we should stay long and we don't get ourselves out early when our signal doesn't cross. That's the thing here. That's what helps us stay in that trade. If we were looking for a 10-day moving average cross to get out, we may have been out. We may not have been able to get back in. But our signal allows us to stay in. So that's what we're doing when we're finding these trends, is trying to find ways to leverage these stocks that are trending from May 1st at 240 to August 31st at 354, a more than 40% rally in the stock, and a 240% return in the options, with cash to go find more leverage trades that hopefully pay out just like that. So that's where I'm going to introduce you guys to the Big League Options. I think I've mentioned it a few times. I'm the portfolio manager for this trading program. I just want to ask you guys to go to optionhotline.com/big league, take a look, find out more. We'll follow up with an email that'll give you a replay of this webinar, along with some more information about Big League Options, so you can see for yourself how this stuff works. Because we've talked a lot about it here, but the best way to find out more about how it works is to actually see it in action. All right, if there are any other questions, I'm happy to answer them now. And I hope you all really take advantage of this opportunity to take a look at Big League Options here in the coming days. All right, we'll give it 1 or 2 more minutes, and then we have answered a few questions here during the chat. So I think that sounds like a lot of people probably had their questions answered through that point. But again, take a look at optionhotline.com/big league, and we will hopefully be able to help you out with your trading that much more on these trending stocks once we incorporate options into your system. Oh, as another note, yes. So we are going to have another webinar coming out in a couple of weeks about our commodities trading program. So keep an eye out for emails about that as well. So I know a lot of you probably saw the webinar last week about swing trading. If you didn't, take a look at the replay on the website. You've got this one for trend trading, and then we've got commodities coming in just a couple of weeks. So keep an eye out for an invitation to that as well. I know you'll get a lot of value out of that one as well. All right, folks, I think that's it. Talk to you guys soon, and we'll follow up with that email with the replay.